Welcome into the bunker. What I want you guys to look at here is just some perspective on the years of asset bubble that we have had. Not a lot of people, when they look at the charts, will show you the weekly chart, this drawn out. Okay. And we can actually see in this chart the 2000 bubble and the 2008 bubble, and the trend line that ensues here has never been touched. Okay. It's never been touched again. Can we get back to this level? Is this an entire bubble that we've just never seen anything like in the history of humanity? The amount of money that's been printed, the fractional reserve system that banks have employed, they've taken your money and they've pumped it into these markets. There is so much money flowing around that even though we have the prospect of hyperinflation possibly later this year with food prices and with oil prices, we have World War III, we have all of these things, but money is flowing so freely that we have, after this sell-off, we have this rally that almost brought us up again to this all-time high level. But in my opinion, we are putting in a classic gravestone doji, okay, which has not been put in on the weekly on the S&P in some time. And we can go back and look at some other instances of a rally that ended in a gravestone doji and what happened after that. But we not only came into we came into some strong resistance here because we can see we sort of chopped up and down. We couldn't break through that, right? And then we finally broke through. We broke through, and now we're making it resistance. Okay, so we haven't made it resistance until just now. And what we're looking at is, again, a gravestone doji after a rally. We're also looking at the potential of a head and shoulders here. Okay, and we're also very wide on the moving averages. So something I like to talk about a lot is when you're looking at the charts, you need to be looking at the weekly moving averages because those will tell you the biggest story, essentially. And so what we're looking at is we're very wide and we still haven't crossed the 20 and the 50 weekly SMA. So nothing has crossed. So we're still just as basically as wide as we've ever been. We can see we had a cross here and that actually almost marked the bottom here. So, maybe we have a sell-off here and then we have the cross and then that's the bottom. Targets for me that I'm looking at, obviously, it's not financial advice, but I want to see us hit this top here around 350 that was put in at after the rally of March 2020, because we had the Fed printing, the government printing endless money after this happened. And so now that we're seeing the Fed stopping printing of money, I want to see us come back to where that printing took us to in that first rally. Okay, so in my opinion, that could end up being around the 200-week SMA. I do think we will touch that at some point. We can see we went below it here in 2020. But honestly, have we ever even seen anything like this? Have we ever been this wide? I mean, for me personally, I've been calling for the stock market to sort of top, and even back in like 2017, 2018, 2019. And then we finally sort of had this blow off here before the crash in 2020, which was a natural thing. I mean, this needed to happen anyway. So it makes sense. But then we just covered it up, right? Like we needed to have more chopping around. We didn't need to have them print infinite money here to bring us up to another bubble that's even bigger than that. And you see like people like Tom Lee, who basically I guess is just a perma bull, calling for 5,100 S&P by the end of the year. I mean, I just don't understand it at this point. I just really don't. I mean, can we look at a chart and someone tell me that the demographics aren't going to matter either? We have baby boomers retiring left and right. We have millennials who don't want to work. we have people not wanting to go back to work. We have an economy where you go to the store and you barely have anyone working there. um, People are basically burned out, and people, we've had a lot of deaths in the past couple of years, um, for multiple reasons. um, so we also have Russia, who is now forming their own system outside of the SWIFT system, where we could basically see the end of the petrodollar. Right now, people are paying for oil with gold reserves, with rubles now. So when you watch mainstream news and you read mainstream news, they essentially cannot tell you this type of alarming information, okay? Because they can't tell you this because they can't ensue panic on the news, right? um they basically are not allowed to have that happen. um and so here's another trend line that kind of matches up here, which I like. So we obviously have resistance, 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 broke above, so that sort of still acted as resistance, and then we made it support here. So this is a really key trend line. And again, this is around 340. I mean, if we don't have at least some semblance of reality here where we come back and touch some of these levels, I just don't think it, I mean, I just don't know how that can play out. And people think that, I mean, right now I see us putting in essentially a lower high here. So, and then, like I said, and then also a head and shoulders target, um, which would really sort of bring us down to like 380. So, it might be around this like 100-day SMA that we get support, and then maybe we crash again. I'm not sure. Um, I just think that this is something to watch out for. Another thing to look at as well is the Schiller PE ratio, which is basically the price to earnings ratio is based on average inflation adjusted earnings from the previous 10 years, also known as a cyclicality adjusted PE ratio. So we can see that company price to earnings ratio in terms of the S&P 500 are higher than they've ever been, besides the NASDAQ bubble of 2000. And after that bubble, we came back down to around 10 in the PE ratio. And right now we're at 36. So keep that in mind. Right now, a lot of these companies like Tesla, which is trading at like 220 price to earnings ratio, or Microsoft at 36, or Apple at 36, these are too high. They need to come back down. And it's just not sustainable. And this is just something that I believe has to come down and to some semblance of reality. Now, where will that money go? Will it just all go into cash and dollars if the world is using gold and rubles and other things like commodities to trade with each other? Well, no, this is where I believe we are in a commodity super cycle. And I believe that the places to be, not financial advice, are always in the next maybe 5 to 10 years are going to be gold, silver, commodities, energy, cash. Even though, like I said, cash, is sort of there's risk in either way, but gold and silver are so uncorrelated to cash, as well as gold miners, I believe in as well. They're very undervalued in comparison to some other stocks, like in terms of price to earnings. And then we also saw the yield curve inversion. And, there's been a lot of mainstream media trying to tell you that, oh, that doesn't matter. Like, oh, it didn't predict every single recession. But it definitely does predict recessions, and it involves, credit risk. It involves the dollar strength. It involves, a lot of different political uncertainties, trade tensions, obviously volatile oil prices, and the bond market really just kind of screaming at us that we are headed into a recession on every level. And so sometimes this can play out quickly, and sometimes it can play out a little bit longer. But I would say that it would be like until the bulk of the of these yield curve inversions plays out, we're not going to know exactly, but you can see here the percent of 10 yield curves inverted. Um, and so we really don't have even that many yet. So imagine when they all sort of start to invert a little bit more, um, we maybe see how this works out. But historically, equity markets tend to produce some of the strongest returns in the months and quarters following an inversion. Only after around 30 months does the S&P 500 return drop below the average. So these are, again, excuses that are being made by the banks and things like that. But I think that the message is clear in terms of where we are in this market. I don't know how. I mean, can you imagine if we come up and put in a new all-time high, like a double top? I guess that's possible. But for me, this just signals a pretty strong reversal. Again, I mean, anyone that's followed me for crypto knows what this candle looks like on the Ethereum chart. And they would know that because I was talking about that at the all-time highs, essentially with Ethereum on the weekly, and talking about how bad that candle looked. So we can see here, this is the same exact candle as we see in the S&P 500. And it's not easy to get one of these on the weekly either. Okay. It's really not. So this is something to watch out for. I know I didn't go back and cover the S&P the past times that we've had a Gravestone Doji on the weekly. I can try to do that. What I believe it was around, I think it was like 2017 or so. Let's see if I can find it again. This may have been something here that's sort of similar, because we also had it sort of close above a moving average. So there's definitely been, a few instances before. Even I think in 2017, if I remember correctly, we saw something like that, but nothing as really as perfect, honestly, as we saw with this one. Nothing quite the same. I guess this, I mean, possibly you could count possibly this. I mean, when you see a weekly average close very thin, a thin body of a candle with a high wick, that's usually saying that, okay, the buyers are exhausted. We saw one here. As you can see, we went down after that. We saw one here, and then we rallied up and made a new all-time high, then dumped. I mean, God forbid that happens, but it's possible. Anything's possible here. I do think it'll take a little bit longer for the numbers to roll in terms of the economy being as bad as it is, people not really realizing that yet. So I do think that'll take a little bit more time. So keep an eye out for that. But for now, what I would, say in terms of how I'm preparing is, storable foods. I think you're going to get cheaper prices now for food that you can put in your freezer or canned food than you're going to get in the future. I've been saying that for a couple months now, but or really a couple years. I've been saying that to people, and just preparing yourself for different scenarios to play out. So you want to have some crypto. You want to have some, like I said, gold, silver, physical. You want to have some miners. You might even want to have some puts that you buy on the S&P 500. Cash, obviously, you want to have some energy stocks. You want to have some commodities. And I think commodities, it's even more important than buying like a commodity fund, would be buying commodities on your own. So type in like, what are a list of commodities, and then just see, can I purchase some of these, like wheat, berries, right? You can purchase that. Can you purchase tobacco? Can you purchase coffee? Can you purchase, just corn, right? Can you purchase, soybeans? Can you purchase, different things that you can consider commodities. Can you purchase oil? Gas, maybe have some storable gasoline with a generator. These are just all things you want to do when we're heading into a recession, which the yield curve is telling us that we are. And so these are just some thoughts that I wanted to share with you guys. Hopefully got something out of the video. If you did, please like, subscribe, and I will see you next time. Have a great day.